Well, we've had some dips, and we've been saying continuously that this is a buy the dip kind of a market. And the reason we say that is because there are more companies that are seeing upgrades than there are companies seeing downgrades. And that has been a situation now, really since the dark days of 2020. And it continues to be the situation. The pace of earnings upgrades is obviously much slower. During the middle part of this year, we saw a pause. But my expectation, and I think our team's expectation around the world, is that we will see a continued revival of that breadth in the market taking shape. Obviously, there have been some concerns about Asia with the Delta variant, with the slowdowns and the lockdowns we've seen. There's been tremendous bottlenecks and cross currents. And of course, there have been concerns about the pace of Fed quantitative tightening. So I think there are a lot of cross currents. We did say that there's going to be heightened volatility, but fundamentally this is a very positive market outlook. And we would say that, look, there are lots of positive things happening at the micro level. This earnings season has seen a tremendous level of beats, and where companies have had margin issues and sales issues due to bottlenecks, the subsequent periods, and certainly 2022, have seen earnings upgrade. So that is why we would say this is very much a buy the dip sort of market, and that is likely to continue for a while longer. Just another point that I would make is that the real debate is a little bit of a longer horizon debate, and we would say that there is so much pent-up demand in terms of big decisions which haven't been made for a very long time, at least for the last 10 years. These decisions are now coming to the fore, and with the adjunct or with the continuation of easy monetary policy, which we see sustained for a very long period of time, this is a very positive market backdrop for equities.
Right. Elaborate a little bit more on what you're buying then when you see those dips. You were talking about earnings season, and there are a number of companies that managed to beat on both the top and bottom lines, but were marked down significantly by the market and by investors, particularly if you look at some of those tech names. Is this the type of dip you're talking about?
Yes, absolutely. I mean, the baby was thrown out with the bathwater in many instances, where there are some, overall, concerns to do with policy, overall concerns due to some of the uncertainties we've seen play out, particularly with, policy reforms that we all know about. So there are a lot of very good opportunities, cash-rich companies that are now trading at multiples that are frankly extremely attractive. And so, the expectations that are now built into those stocks are extremely modest. A month ago, we said that in our portfolios, we were very, very overweight India. We scaled back on that very large overweight. We're still overweight, but we've recycled some of those gains into particularly China, industrial names, automation names, and also technology. Some of those big tailwinds that we've been talking about, particularly localization and technology in China, is very much intact. And certainly, with a lot of companies that we see now becoming global players in Asia, this is a tremendous opportunity to pick up some of those names that have really underperformed because of those headline issues and the headline noise that we've been reading about literally for the last 3 to 6 months. And so Asia now has an opportunity, I would say, to close that gap in performance, particularly with the United States. The worst of the bottlenecks is likely to be behind us. Certainly the first derivative, the rate of change, should now start to look better, particularly in terms of pricing power, pricing pressures, and the bottlenecks that we've seen so far this year.